Yeah, we can allow.
Yeah, the session has started, sir.
We will wait for 1 minute to the participants.
Sure.
Happy evening to all of you. Welcome to today's Investor Awareness Program. We have with us CA Shanket S. Nayak, who will handle today's session. On behalf of SIRC of ICAI, I welcome you, sir, for today's session. We will start today's proceedings with the invocation of ICAI motto song as a mark of respect to our Mother Institute, because of which what we are all today.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता
Thank you. I'm happy to introduce today's speaker, CA Shanket S. Nayak. CA Shanket S. Nayak, a commerce graduate and a fellow member of our institute, having more than 10 years of experience in CA practice. He has done his diploma in information system audit by ICAI. He is also a certified public accountant from USA. He is a registered valuer for securities and financial assets with the Insolvency and Bankruptcy Board of India. He also did a certificate course on valuation conducted by ICAI. He has also completed diploma in international taxation by ICAI, specializing in tax litigation, direct and indirect taxation, fundraising services, project reports, valuation, etc. He has addressed various professional forums like Saraswat Chamber of Commerce, Mangaluru Productivity Council, Goa Chamber of Commerce, and various chapters of ICAI, including Mangaluru, Bellary, Belagavi, and Habali. He regularly appears as a resource person on TV channel Namma Kudla in the TV show Business Tonica. Also a key resource person on the Intelligent Investor on YouTube and Instagram on the topics finance and taxation. He also takes up guest lecturers in MBA colleges in relation to valuation and other professional topics. He has co-authored 2 editions of the book, A Minute to Finite, a finance ebook. With this brief introduction, I once again welcome Shanket S. Nayak to handle today's session. Over to you, Shanket.
Thank you. So let me just share my screen. I hope it is visible to you.
Yeah, visible.
Okay. So let me start on this topic. So there are various products which have come up in the recent years. Some of the older concepts we are familiar, and as far as taxation is concerned, we are all chartered accountants. So to a large extent, I think we are familiar. But there are a lot of newer products which have come in the last few years. So let me take you through some of those products as well, and also we can also look at some of the old traditional products as well. And if anyone has any queries, they can definitely ask, and we can discuss that.
Members, you
So
can raise your query in the Q&A option available in the Zoom, or you can also raise your hands so that our technical team will unmute you so that you can directly ask this question with Shankar.
Yes, thank you. So let me start with one of the first topic what I wanted to discuss was in relation to index fund ETFs. I mean, ETFs are exchange traded funds. So this is a popular concept. While we are all familiar with shares, I think to a large extent, ETFs are also a good product which are normally there in the market. And index funds, ETFs, what they do is they follow the index which is there in the market. And what happens is, let's say it could be Sensex or Nifty or anything for that matter, the index fund ETFs will follow these products. And accordingly, what happens is a person, otherwise, if he wants to invest in any product, it becomes difficult sometimes because there is continuous monitoring which we may need to do if he's purchasing individual scripts. So here in index funds, what happens is already this is done by them, and end of the day, what happens is you can just invest the money in that product and it will mimic the market returns. So of course, there can be doubts in the market, but in the longer run, we have always seen that the market will give us a good, decent return. And there are certain charts as well. So there are two main products here. One, there could be mutual funds which invest in index-based products, and also there are ETFs also. There are two different products, but they are following the index itself at the end of the day. So most common would be equity-based indexes. I think we can have products which can follow the Sensex or the Nifty, and these schemes will give us the same return which is given by the market. So at the end of the day, we need not concern ourselves with looking at what return our product is giving, what return a particular share is doing, or whether that share is going down or for whatever reasons it is, or market sentiments and all these things. In the short term, there could be fluctuations. Definitely, that is there with any product for that matter. But in the longer run, usually they have given consistently good returns. Similarly, it can be there in any product. For example, it can be there in bonds as well, where they may follow the interest rates and all movements in the, and could be for commodities and fund of funds, wherein they could be following multiple funds as well. So there could be a combination of multiple funds. So that is an FOF. So that could also be one of the products. And there could be currency related or any other ETFs as well. So the ETF by itself is a broad terminology. What it says at the end of the day, it will follow any underlying, any item, could be any commodity, could be gold related as well. It could be share related, could be index related, could be sector related. So specialty ETFs will be similar. They will follow a specific industry. Could be information technology, could be manufacturing, could be FMCG, could be multiple things like that. And there could be certain newer schemes like sustainable ETFs, where they do it only in companies which make an impact on the environment. There could be other products. And so on an overall, this one, we can see that the liquidity though is good in these products. You can always exit. Normally, in most cases, you can exit and on any day if you are free to enter and exit. So, and the risk, of course, is the equity risk which is there in the market. It is not risk-free. Of course, there is risk involved. It is not, maybe can't say it's a 0% risk, but there is some risk, but at the same time, the returns are also quite good. Liquidity is quite helpful. You can always liquidate this whenever you want. If there's any urgent need of funds, these are some useful options there. Also, in case of let's say certain products and certain ETFs, I think you can pledge them as well. And you can get a return based on the market value. Certain banks and NBFCs may also give money in that way as well. So if you look at the returns which the indexes have given, so these are some sample products which we have taken and we are just examining them. Over the 1 year return could be due to various reasons, because the market may be in the short term a bit on the lower side. But if you look at the 3-year return and the 5-year return, these are usually, they are quite good returns given by these products. And in the long run, that's what you are usually going to get a good rate of return in these cases. 1 year, there could be some market sentiment which is there, because at the end of the day, we had seen COVID-like situations when markets were doing good and suddenly due to some external factors it could have dropped at that point of time, but subsequently it has gone up as well. So this could be one of the things. And if you look at the historical returns which the Nifty has given, and we are seeing it even now, this is only till 21, and even till now, if you see within a few decades, we are seeing such a growth which which the index has taken. Similarly, if you look at the year, so on year basis, we have collected this from the Nifty's website itself. So here you can see it is in certain years it goes even up to 24%, 30%, 70% could be abnormalities because of a fall in earlier years. But normally 15, 13, 20%, 30%, these are all decent returns which you are seeing the index giving. So of course there could be a few years where there were drops like 13%, 15, 51, 23. I think that was due to the recession, the 2008 drop. But subsequently in the next year itself, the markets have bounced back. And so normally in the longer run, they're usually giving a good rate of return. And if you look at the Sensex, 1980 onwards till date, it has grown all the way till 60,000 odd amount right now. So we need not even have to go very back. I mean, 1980 could seem like for someone who is not, who has just started investing, maybe in the last, it may look very old, but of course there could be people who have been investing from that point of time as well. But if you look at it even in the last decade as well, from 21,000 to 60,000 is an incredible journey itself. From 2013, 21,000, 2023, where it's 60,000. This itself is quite multifold. It's about a 3-time increase actually. So it's a very good return. So these are some things about index funds which I wanted to bring out. Similarly, there one more product which you wanted, of course, real estate is something which I think is very ancient and old from time immemorial. I think all communities and all people at the end of the day have been investing in real estate, because at the end of the day, they know there is something tangible, something which they can see, and people have beliefs that it will normally give a good return. So in most cases, yes, real estate is a good product, but again, you need to see what kind of real estate we are referring to. And there are newer products which have come in this as well. So I can take you through those as well. So as I said, so it is a very good investment. Normally in the everyone's mindset is towards real estate. Everyone would want to buy a house. Everyone would want to buy a plot or buy construct something there, or in the past it used to be agricultural land, and today of course nowadays it's, we don't get to see a lot. In some cases we may see agriculture, but normally it is mainly residential or commercial. But at the end of the day, a house which you purchase should not really be considered as an investment if you're paying for yourself, because at the end of the day this is more of an emotional attachment rather than from a commercial or a investment point of view. Let's say beyond that first house, if you are looking to buy something, then maybe we can consider it as an investment. Otherwise, the first house, I think we should not consider it as an investment as such. Of course, the second, now many people after the first house, they tend to buy a second house and third house and so on. But at the end of the day, we tend to see that the returns in residential is not that great. You may buy a property for, let's say, even an average property nowadays may go up to 1 crore as well. But the returns which you get, you see that it's very negligible, the returns which you get on those properties. So real estate for your own use, definitely it is it may make sense. But for investment point of view, whether residential real estate is relevant, maybe not. Maybe we can look at other avenues like commercial properties or other products which are available as well. And let's say if you are having your own businesses, then of course commercial property or industrial property and all these things make sense. But again, that may not be purely an investment point of view. But again, there as well, you get some returns. Now, of course, we are aware that in most of the cases, there is some tax benefit as well, wherein I'll not go deep into the taxation aspect of it, because I think we are talking in the CA and so on itself. So most of us would definitely know the tax positions. But normally you are usually get a 30% standard deduction here. And one of the main advantages is you can mortgage these assets. So normally in some products, some innovative and newer products, lenders are still not familiar with them. So there may not be any return, any mortgage which or pledge or which you can do. But in real estate, that issue is not there. In most cases, you have a real estate property, you can get a loan as long as it is legally clear and all these things. But additionally, let's say it's a commercial property or so and so. One more advantage which you usually tend to enjoy is, along with the appreciation, you get regular income as well. There's a rental income or something of this sort which is also available. Now, physical assets, this is what we normally see. Of course, and this is over the long run. In a physical real estate scenario, we see that liquidity is a big issue. Let's say I buy a property today. There are two things which I need to give in. I need to have a good sum of capital, which of course bankers are helping out in this by giving loans for different products. But one more reason is, let's say I buy something today. It is very difficult for me to dispose it immediately in most cases. I will not be in a position to get good immediate disposal of this product. I may have to wait for at least a few years. If I'm in a very urgent situation, I may not get a good rate as well. This is something I think we all see. So for this reason, one more product which has come up in this space is REIT. I'll just explain about. So that is why I was saying physical and digital, whereas the old products were all physical and tangible land and building. Now we are seeing this concept of REIT as well. Let me just go there. So REIT is one of the new products which are there and which just came in a few years back. Of course, this concept was there internationally for quite some time, but in Indian markets, it just started a few years back. So REIT, I think, stands for Real Estate Investment Trust. So here what happens is, it is one of the biggest advantages as far as this product is concerned is the liquidity factor when compared to a normal real estate product. I think we are all know that in case you purchase a physical property, it is not an easy job to get it sold. It will involve considerable amount of time and lot of factors involved. But this is where this product comes in, wherein in REIT, it is listed on the market. So as long as the volume is there, which is there in most of the cases, you can immediately sell the product as well, which is a big advantage against the traditional real estate product which you used to see over the years. And also it is transparent, and you get regular incomes where they are supposed to distribute a large portion of their incomes to the unit holders. So, and at the same time, this also solves one more problem, wherein you usually require a large sum of money to invest in real estate. Whereas in REIT now, earlier it used to be somewhere around 50, 60, 70,000 or something, where there are multiple lots. Then they made it subscription at 10,000 or so. Now even single unit of REIT can also be purchased. So this is a fantastic product, I feel. Of course, there are very few still there in the market. As on today, I think there are only a handful of them, maybe in single digits. So the risk, of course, it's not totally risk-free. At the end of the day, it depends on how much returns that REIT, whoever is promoting that REIT gets it. But the returns are usually quite good. You get regular returns. That is one thing which is a good, where they're supposed to compulsorily distribute the income. This is a very good feature of this product. Liquidity as well is good because you will be able to usually sell it off in the market. The only exception could be, let's say, if the market is closed, or if let's say if there is very low volume, which is something we should be very careful when investing in any product which is listed on the stock exchanges. You always need to see what is the volume available, because if there is very low volume, if there is no one ready to buy or sell that product, then of course it cannot be said to be liquid. So it works similar to a mutual fund, wherein funds are collected from various investors. So earlier it used to be, like I said, now it is about some 70, 80,000 or something, which is still okay. But now they even brought it down to 10, 15,000 as well, the subscription amount. And the trading unit is even lesser. It's just, I think nowadays it allows even 1 unit as well to be purchased. One of the major reasons why it can deliver returns is because it invests in commercial properties. And one of the major criteria which it prescribes is that it has to distribute 90% of the income to the investors. So this is the reason why you get continuous returns, and also you will get appreciation. Of course, the last few years, the market situation due to COVID may not be the greatest in the world, but going forward and in the future, I feel this product may really give a good, maybe a very good product. And these are some of the currently listed. I think there are only 4 or 5 probably. And these are I think Embassy was the first one to launch off. And then there was Mindspace and Brookfield. Earlier it was 200. I think now that is also dropped to about 1 unit as well. And the distributions are about 7-6% and so on, which we are seeing. And the market value is about 275, 300. And so here what happens is they have to invest 80% in completed or income producing assets. That is why the distributions are usually good, because if it is under construction properties, they will not be having income, cash flows to distribute any income. Whereas in REITs, what happens is, since it is dealing in income producing assets, completed products majorly, so that is how you are able to get a good return. So this is one good product which we can compare with our existing real estate physical property. You can similarly compare this as a digital product, and which is listed on the markets where you get good returns, and which is possible with a very small sum of money as well. Now, one more product which has come up recently is InvITs, which is Infrastructure Investment Trusts. So this is in some senses it may be similar to a REIT, but there are some differences there. Let me just take you through that. So here what happens is there are a lot of infrastructure projects which are there in the country today, and this requires a lot of investment. And what happens is, in most of the cases, they're usually approaching lenders and they give loans, but there are a lot of constraints there as well, wherein we see that there could be issues of income coming on time and approvals, and lot of the situations, and the sum required is quite huge for our economy at the moment. There is a lot of investment required. So that is why this product has come in, wherein any project can be launched, can be given as an InvIT, wherein they have to give a regular cash flow, equally easily liquidable, because what happens is it's listed on the market, so you can sell it as well. There is a lower risk because you get regular cash flows and it's listed and it's regulated. SEBI has given the regulations, and there are rules to follow. They cannot just invest wherever they want. There are set guidelines where they need to invest. So they could be privately held and publicly held as well. So in most cases, publicly listed InvITs are where any common person can invest. Privately held could be something which only let's say HNI or institutional funders maybe. I think it's mainly institutionalism. Public listed, it is something which anyone can invest for that matter. And they can be bought and sold in the stock exchanges. So that is one major plus point, when you get a lot of liquidity there. Let's say you buy it today, you can sell tomorrow, or in a week's time, month's time, a year's time. So what happens at the end of the day, of course, you have to see what will be the market rate on that day. So that risk will be there. But normally they are doing quite well. So these are some of the things which we could see in the public domain. There was power grid infrastructure and IRB InvIT fund, where the prices are quite, I mean, 120, 72, and the returns about 14%, 12%. These are quite good returns. And here as well, there is a condition that 80% of the value should be invested in complete and revenue generating infrastructure projects. So similar to REIT wherein it was there, similarly we have a condition here as well. This is because the returns to be given to an investor at the end of the day can come in from a complete project rather than under construction property. And here as well, 90% of the cash flows needs to be distributed, and there is a subscription range was earlier 10 to 15, which was earlier a bit higher as well in this as well, but they want to encourage more and more retail investors to invest in these products. That is why they have kept it quite low, and now even one unit is also sufficient. And the distributions could be in the nature of interest, dividends, and revenues. And I think in today's date doesn't make much of a difference, because earlier there were tax differences, but now dividends also are taxable, and of course the taxation could be different for some, could be small changes there, but normally in today's date may not make much of a difference. But one of the main, the risk factor is a bit low, the returns are quite decent, the liquidity is also quite good. So this is also one of the decent products which we are seeing. One of the things which also is there in both the REIT and InvIT is that the debt which they can borrow is capped. Actually, in both of the cases, there is some capping which has been prescribed, so that all the money doesn't go at the end of the day just for debt repayments. There should be something available to the investors as well. That is the basic idea behind that, and they seem to be. And I think recently the government has launched one more InvIT as well, wherein they are looking to get good returns for retail investors as well from certain government companies as well. Of course, this can be done by anyone, a government entity or a private entity as well. And so the next option which we are SME, I think you are familiar with the concept, but what I am going to talk about here is SME shares. So at the end of the day, we know that the regular stock market is something which we usually see. But in addition to that, there are certain shares of SMEs which can be listed on the market as well. As far as these products are concerned, now what happens is it is not at a very small lot size. The amount which you need to invest it is a bit higher, because there's a bit of a higher risk when compared to regular shares. But what happens is there is a good return as well. As and when usually the risk increases, the returns increase as well. So due to these reasons, SME shares are one of the investment avenues which are available, which we are seeing nowadays. And some of the things, the returns which these have given, they are unbelievable. They over few years, what we are seeing, 800%, so about 8 times, 7 times, 6 times, 5 times. So that's a very phenomenal growth. But of course, there are hits and misses. So there are stocks which have tanked as well, and there are stocks which the volume is not that great. So unless there is volume, the price doesn't make much sense, because you will not be in a position to sell that product at the end of the day. So as far as SME shares are concerned, you can normally sell them when compared to, let's say, a privately held company, wherein there are a lot of restrictions for transfer, or even a public company which is not listed as well. It will not have a ready market. SME share is usually better than these products, but may not be as great as your normally listed shares. So these are some things which are delivered returns. Of course, there are cases where it may be on the lower side as well. Because the risk is higher, they have SEBI and the government has kept the investment size a bit higher than a normal product. So we saw in REIT, InvIT 10,000 and sometimes 1 unit as well. Here, they have not reduced it to that extent. It could be, there are various prices for which there are various price ranges for which there are various quantities prescribed. So normally it could be around 1.4 to 1.5 lakhs. This is because they want to make sure that there should not be a very new a person without much income should or with a very lower income should not really tend to take so much risk at the end of the day and get their fingers burnt. So for that reason, the amounts are a bit on the higher side, but the returns are also quite good. We are seeing that they are delivering good returns. And at the end of the day, there is always risk as well. So there are cases where they have flopped and where they are not giving, I mean, volume is not there, and all these concerns are always there as far as this product is concerned. Now, one more thing which you wanted to see is investment in foreign equity. Now, there are a lot of foreign companies, especially in US and Europe and so many countries, which products we use in our daily life. We see Apple phones everywhere. Uh, we are seeing so many products like Google. We use a lot of their softwares and a lot of their portals. So, whether can we invest in these companies? So, yes, today's day it is possible where you can invest in a foreign share as well. Of course, there will be two things to be kept in mind there. Along with the share price movement, since we are investing from here, we also need to keep in mind the currency movement as well. Because let's say right now the currency is going upwards, so person who is investing will get good returns. But let's say there could be a situation with if it behaves differently, then that will affect the foreign investment as well. So it's a diversification which people may be already investing in Indian stocks for a long period of time. They may want to invest in certain products, and there could be there are a lot of products and currency diversification as well. Now, what happens is people may want to invest abroad, and sometimes they may want to utilize this money abroad for different reasons. Of course, there is an LRS limit of $250,000. So if you invest gradually over time, you can always utilize these foreign listed funds or shares in the future as well for those needs as well. That is one more reason why there is currency diversification was mentioned. And the direct investment options are also available today, wherein there are domestic brokers who are tied up with foreign brokers with whom you can usually get in touch with and invest. Also, there are foreign brokers which could be directly or indirectly through these channels with whom you can do. The most, I think, famous market is the US stock market, which I think people, and globally also this market usually determines the way other markets behave as well. The global markets are usually one of the reasons. If we see that the US market has fallen due to whatever reason, we usually see that the Indian markets will also drop in the following days to come. This could be due to, I mean, that is why they are currently one of the, I mean, where the economy is quite strong or where it is followed. The US currency is usually recognized worldwide. Of course, we are right now the rupee is gaining a lot of traction, and we are seeing that there are so many Middle Eastern countries, I think now, which are accepting INR as well. And there are other, due to the lot of tensions in Europe, we are seeing a lot of other options coming in as well, wherein there are other currencies which are being accepted. So as of now, you can invest directly in the US companies for that matter into their stocks. I think in the past, we used to see only people who were usually working for subsidiaries of these companies had this option where they used to get ESOPs and they could retain this, but now anyone for that matter can do this. And secondly, there are other options wherein you can invest in mutual funds which are there in India as well, which invest at the end of the day in the foreign shares. So this is an indirect way where you can invest, which will also give similar returns, and it will invest in multiple shares. And there will be professional persons who manage these funds. So as a reason, you get you did not have to worry at looking at these things. But of course, it has its risks as well. And there are ETFs as well where you can purchase directly or through international brokers, and even similar to mutual funds, there could be other products which end of the day invest in sorry, foreign stocks or foreign equities. So some of the common, very famous, products which we are seeing is Google for that matter. The company is Alphabet, where we're seeing the market cap is in $1 trillion and the share price and the returns which this gives. And there's Apple, I think, which everyone knows today due to their phones and iPods and laptops. They are also listed, and there's Tesla and Microsoft. So these are some of the more famous companies. It's not, we can invest in a whole lot of companies, just some of the popular ones which I wanted to give an example of, so that we get to know what we are dealing with. So here what happens is LRS, which is part of the FEMA law, wherein where there is a restriction given up to 200,000 US dollars. So you can invest to that extent in a year, of course, but it is not only for this particular reason. It could be for all your foreign expenditures or foreign investment clubbed together. It should be falling under this. Of course, there are other caps and other conditions prescribed in certain cases, but normally you can consider this limit. Of course, there is no restriction on the number of times you have to invest and frequency you have to invest and all these things. But the foreign currency rate keeps fluctuating throughout the year. So that's an additional point which comes into mind when compared to local equities. You just have to see the price. You may need to see the price as well as the currency movement as well. So as from the risk point of view, there is a higher risk which is prescribed due to this reason. The returns are concerned, they are quite decent because you usually get a good return. But what happens is the interest rates in foreign countries are usually lower when compared to Indian returns. So in many cases, we are seeing the other way around, where people do invest in India as well. But this is one more product where you can diversify and get a good return. But of course, you have to keep in mind the currency movement as well. And liquidity factor also comes in, wherein you can sell it as well, but it could be there could be a few more days required for the money to be transferred to an Indian account, or if you just want it in a foreign account, or if you own a foreign account, that could be something different. But of course, having a foreign account, there are many rules involved over there. So for resident individuals, it may be a bit difficult. For a non-resident person, I think it is more easier. But from an Indian account as well, I believe you can invest in this. You don't need to have a foreign bank account. So I think mutual funds is something which everyone is familiar with. We keep seeing so many ads, we keep seeing so many things and so many cases where we get mutual fund products which have been dealt with, that they are being sold by banks, they're being sold by fintech companies. Even if you go nowadays to any website, you will get some link where they'll say you can subscribe to this mutual fund, and they start sometimes as low as 100, and I don't know, sometimes even lower nowadays, which earlier used to be about 1,000 or 500 and 5,000 earlier. Now they have dropped in, the minimum amounts have come down a lot as far as these are concerned. I think people would be familiar with this, but let me take them through. Of course, you get economies of scale because there are so many people who invest in the product at the end of the day. Unlike in a share where it could be just some numbers, here it could be even a larger group of people who invest. And what happens is you may get a dividend as well, if that depends on the scheme which you opt for. If you opt for a dividend scheme, you'll get a dividend as well. If you opt for growth, then you will not get a dividend. But at the end of the day, that will get reflected in your NAV at the end of, you will get that return. But it will be in the increase in the price rather than money coming into your account. There are products like dividend reinvestment as well, wherein dividend is declared and immediately invested into that product itself. And one of the key advantages is that there are professional fund managers who continuously monitor this. So many people, it is very difficult to keep following the markets. I mean, of course, it's practically impossible to time the markets, but at the end of the day, a person who has invested in individual share may need to look at the markets on some regular frequency. Whereas in mutual funds, normally you don't have to take this worry, wherein in most cases, there will be people who will be doing that professionally in the company. Of course, there are cases wherein we have heard wherein the mutual funds had liquidity issues as well. But that's a very rare exception, I think, rather than the norm. And the mutual fund market today has grown to such a large extent with so many retail investors coming in that sometimes our markets are in some cases getting insulated from global movements because there is so much domestic money which comes in. Of course, to some extent, may not be totally. There are so many cases wherein some small things which happen in the global environment will affect our markets as well. Now, mutual funds could be for any of the products. They could be for equity index funds, I explained earlier. So mutual funds can also be in the form of index funds as well. There could be money market funds, fixed income funds, hybrid funds, balance funds. So equity from that point of view, there are various things like large caps, blue chips, medium caps, small caps, and so on. Index funds can follow the index. Balanced fund usually balances both the equity and the debt. So you get a decent return. At the same time, your money is also protected to a certain extent because of the investment in debt, which does not involve high risk. There is some risk always. And money market funds, what happens is this is quite popular in many cases wherein for very short-term needs, there could be some money which is available with the person or a company for that matter, and they may just want to get some returns on it for a very short period. This could be a week, a month, or even it could be for a few days as well. So there are a lot of the companies who invest in money market funds because normally we see in current accounts, we don't get any returns as such. For an individual, I get something in SB which is still doesn't beat inflation, but still you get something. But in money market funds, what happens is you can invest in certain products wherein it will have very low risk, but you get some return rather than having no return, some return, which is something is better than nothing. But many people do this for treasury operations and all these things. Fixed income funds at the end of the day will invest in a lot of products, could be debentures, could be bonds, and could be a lot of the products which a retail investor cannot get into in his own capacity. There could be some products which have quite a high entry point, which an individual cannot invest in individual capacity, but a mutual fund may be able to invest in this. So you can indirectly participate in such products by looking at a fixed income fund. Hybrid funds at the end of the day, what they do is they will invest in multiple products, could be equity, debt, and many more things as well. So you get the best of all the returns, and the risk also gets adjusted. Of course, long-term capital gains only for equity for that matter. Up to 1 lakh, there is that exemption, which was because of the introduction of taxes in capital gain. There is also this 1 lakh cap which has been given, which many people can utilize, which is also being tax harvesting. Many people, there are a lot of articles and videos which come up on this topic as well, wherein a person can always, if they are having a certain amount of money, let's say shares worth, let's say 5 lakh or 10 lakh, so at the end of the day, if you keep selling them over after the completion of a 1 year long-term tenure, you will have this 1 lakh exemption which you get. Now, let's say you do this over multiple years and again reinvest in the same product. So at the end of the day, if one fine day you sell the entire portfolio as well, you would have broken that gain into that 1 lakh over multiple years. Whereas in case you just sold them off on just at the end of certain number of years, then you don't get much, you'll be only subject to that 1 lakh benefit. So that is a concept of tax harvesting, which I think you can get in equity and equity-oriented mutual funds. And in any case, you don't get indexation for listed securities, I believe. It is only for unlisted. And I think now for debt as well, that has gone off in the budget. So from the risk point of view, it varies based on the product. So an equity mutual fund could be more risky. Debt or money market mutual fund can be lower risk. Returns, again, equity is higher, debt is lower. Liquidity is usually good. unless it's a close-ended fund. If it's a close-ended mutual fund, they will have an objective that they will invest for a certain number of days, could be 3 years, 4 years, and so on, which earlier it made some sense because of the indexation benefits and all these things. But but still, in open-ended fund, it can always be purchased and sold. But in some cases, there will be an exit load which is charged if you sell within, let's say, a year or 2 years, depending on the fund which you're investing in. But normally for money market funds and all these things, they don't charge that. But always what happens is, in many cases, debt mutual funds are also not completely free of risk. Now, what happens is, in equity, what happens is, even if, let's say, a particular script goes bad, the other equities may, at the end of the day, give a great return or a good return, which will compensate this loss. But in debt, what happens is, if some debt goes bad, the other debts will not be in a situation to give a better return to compensate for this loss. So even in debt mutual funds, it is not completely free of risk. But again, we have to see what that mutual fund is investing in, the underlying returns. And of course, the returns at the end of the day, the past returns will be available to be seen. But we can never predict that the past returns will be the same in the future. There is no guaranteed return as far as these products are concerned. But what we need to see is that past may in some cases make sense, but may not exactly be the same thing in the future as well. There are some people whom I have seen who have invested just the NFO amounts, let's say 5,000, 10,000, and all these things few years back, few decades back, and have seen phenomenal growth as far as mutual funds are concerned as well. The other popular thing we see is SIPs, wherein systematic investment plans, where people who have regular income keep investing in that product, and over time they get averaging of prices which happens, and they get a good return as well. But even if you're someone who is not having a very monthly salary, you can always invest as and when you have some money which comes in, you can always invest in this product as well, wherein you can invest, let's say, on a particular day, you can invest few months down the line and you get some more money coming in. So there is no hard and fast rule that it should be done on that date itself. It can be done on any date for that matter. So that is one of the advantages as far as this product is concerned. And portfolio management services, PMS, is also one more product which comes in, but the cap is a bit more higher. Here what we see is normally the ticket size is about 50 lakhs. So it's not for a very small time investor, retail investor. Could be for someone who is an HNI or someone who is having a lot of corpus available. They can also look at it. Here what happens is there are people who manage the fund. They're usually experts, and they have multiple strategies which are there. And based on that, they do say that they will get a better return than the market. Some of them do get that, sometimes maybe not. But again, it depends on tenure and all these things. Normally, I think they do beat the market return. Otherwise, people may not really invest in the product itself, because the market itself is giving you that return. Then why would I want to take additional risk and put up additional money in this product? But what happens is, there is an expert involved here, and there could be customized plans, and the risk management is looked at more on a more microscopic level, and there's regular monitoring. They usually give regular updates to the investors as well. And what happens is, you have active funds and passive, discretionary. Not so active would be in a much more regular frequency, whereas passive may not be at that frequency. Then there, of course, there's discretionary and non-discretionary fund portfolios as well. So the risk is a bit, it's there. It's not very low, not very high as well. The returns are usually better than the market, so it's quite decent. The liquidity, I believe it is not as free as an equity share or a mutual fund listed on the market. There may be certain time limits set by the person who gives the money, so that and again, it may vary based on the PMS and all these things. Some of the things which we were able to see in the open market, some data which we saw some 22%, in some cases 20%, 35%. Of course, there could be, I mean, there are risks involved as well. And since the small investors, because of the risk factor, they have kept the minimum amount close to 50 lakhs, which used to be 25 lakhs in the past. And I think even if you go certain years back, maybe 5 lakhs or something. But today, I believe it is around 50 lakhs. So, and they may increase it in the future as well. So that is to make sure that there are people who can take that risk, and only those people can should invest in the product. If you are not able to bear that risk, it is not advisable to invest. So let's say someone has 50 lakhs, but that is their entire life savings, may not be suggested, advisable to invest here. But if that is, let's say, just one of the funds which you are having at the end of the day, and you have multiple such amounts there, then probably you can invest in this product. Now, of course, cryptocurrency is something which we see all the time, but I think not many people know what it is. I may also not know much about what it is, but I'll just briefly try to explain it. So what happens is, in cryptocurrency, there is where there are people can transfer it from one person to another, and wherein what happens is there are a lot of these players who are going about this. And the taxation aspect of it just got introduced, I think, in the last budget or so, where they are trying to tax it 30% and so on. But at the end of the day, the risk is very high in this product. The reason being that there is still no clarity on the legal recognition of a crypto asset. There is a taxation which has come in, very recent, a specific tax angle which has been brought in, which some experts believe give it the legality. But at the end of the day, there are a lot of negative sentiments also about this, and there are people in the administration and government also which have not expressed very positive signs about this product as well. So the returns may be okay, the liquidity may be good, but until the legality is confirmed, we don't know for a fact at the end of the day what will be the future of this product. It is doing well. We are seeing a lot of people investing in the product as well, but it is a high risk product at the end of the day, because we don't know how much we'll be able to gain at the end of the day, or whether this will be valid, or whether there will be certain sort of government backed crypto, and there are a lot of discussions going on. We'll need to see how that plays in the future. There is something similar called NFT, which is non-fungible token. Now, the difference between this and crypto is that NFTs are usually non-transferable, whereas not non-transferable. They are not easily, they cannot be duplicated, I believe. There could be a single product as far as NFT is concerned, whereas crypto is something which can be transferred very easily, and there could be multiple such items as well. And NFTs could be relating to art and music and many of these products as well. So there's a unique this one ID in relation to each of these things, which is why when compared to, it says non-fungible, so it's not as easy as a crypto. But at the end of the day, here as well, we don't know, because the returns are quite uncertain. The risk is very high because we don't know how the regulatory scenario is as far as this product is concerned. The liquidity is quite okay because it can be transferred. But at the end of the day, we don't know to what extent, if the regulatory bodies decide that it should not be allowed or it should be banned, then it's very difficult for people who invest in these products. We should be very careful as far as this product is concerned. And similarly, we have NRIs who can invest in India. So there are certain things which an NRI has to keep in mind when they're investing in India. They may not be able to invest in everything which a resident can invest in. To a large extent now, they can invest in many of the products which a resident Indian can also invest in. But there are certain things where they are prohibited as well, or the certain regulations and rules which are in addition to what is there. Now, as far as mutual funds are concerned, that is there. As far as equity is concerned, I believe delivery-based transactions are permitted, and as far as insurance is concerned, to a certain extent as well, ETFs, NPS. Earlier, there were some restrictions for foreign citizens. I think that is allowed as well now, and in bonds as well to a certain extent, and FDs in NRO, NRE products, I think, which are some things which people know from a very long time. Real estate as well, people have been doing it from a long period of time. But what we need to keep in mind is there are certain restrictions in relation to agricultural properties and so on, wherein NRIs cannot invest in. Many people sometimes are not aware of these provisions, and you can end up with a lot of penalties under FEMA regulations. Now, repatriation, this is wherein they can transfer the funds out of the country as well, because some of them may not have plans to come back to India as well. There could be people who have taken citizenships of other countries, or sometimes they may not be citizens, but they just come in once in a while, or once in a year, or sometimes once in a few years as well. So they may want to take the money out of India as well. We'll need to see on a product by product basis whether they can repatriate or not. And there are certain caps prescribed as far as repatriation is concerned as well. Now, the advantage, of course, when I was explaining global markets, when a resident can invest abroad, the other way around also is advantageous, because the returns normally which you get in the Indian markets are usually quite better than some of the global markets as well. And you get very good returns, you can diversify, and for many people who have an objective of coming back to India as well in the future and are just abroad for a few years, and especially in certain countries like the GCC countries where it's very difficult to get citizenship. They know that they will be there until their employment tenure, but they may come back after that. In such cases, they can also have it in mind that they can build up a corpus here. And normally they do know that the Indian market is quite investor friendly as well. Due to those reasons, NRIs may want to invest in India when compared to global markets as well. And there are many countries wherein you don't know your immigration status for years together, wherein you don't know if you'll get the citizenship of that country, you don't know if you will be getting a long-term residency as well in those countries. So in such cases, it makes a lot of sense to invest in the Indian market as well, because you may have an idea that you would want to come back as well. The ULIP product, which I think has been there for certain timeline as well, but again, I can just reiterate it. So what happens is, it is an insurance product at the end of the day, which is also an investment product as well, wherein it can invest in equities. In the past, this was very attractive because of the tax advantages, but to a large extent, that has been cut down now. Today, because of the last two budgets, wherein they brought in a lot of caps as far as ULIPs and traditional products are also concerned. So high value people used to invest lakhs together, sometimes crores together, and get investment benefit. That has come down now, of course. There are only to a smaller extent you may be able to get some tax benefit. Otherwise, most things are taxable. And they can invest in various products. It could be equity, it could be debt, it could be balanced funds, cash funds. So it could be, there are various products which you can invest. And also the additional option was that you used to get an insurance cover as well. So that was one of the advantages of investing in a ULIP product. But again, there are various other products today in which you can invest as well, which can give you a good insurance cover itself without going into this. But this is one of the products where you used to get both, and even today this does exist. And it could be various purposes like education or wealth creation or retirement. Because what happens is, when the money is locked in for a certain point in time, you tend to get better returns because they will remain invested. Whereas when there is no lock-in, the tendency is normally to utilize it for some short-term requirement. And we spend it off usually on such things where we don't get a decent return or a good return at the end of the day. that is why these products are also good to a certain extent. There were, in case of death also, you used to get, because it was also an insurance product. And of course, now there are caps which have been prescribed by the union budgets, and many of the earlier in the past we used to have advantages as far as these products are concerned have come down. Now the returns are quite good. The liquidity, it varies, but after a certain point in time, I believe you can withdraw the money as well. The risk is a bit higher in equity products as well, because equity gives a good return, but also has its own risks. There are cases wherein they can usually take up higher risk. But of course, nowadays the allocation charges, all these things have come. I mean, there is a cap imposed by RD, I believe, and also the market also today ensures that whoever gives the better product to the customer will usually get the customer at the end of the day. So that is also influencing, where we are seeing the allocation charges is very small amount, whereas initially when the product came in to compensate distributors and this one, they used to have, I believe, very high allocation charges as well. But all these practices have been come down now, or are not there at the moment, at very small amount, because if you charge higher amount, the customer will definitely study both the products. And today, with so much information available in public domain, it's very difficult for you to you have to offer the best product, otherwise it's very difficult to attract investors. Now bonds are one more investment option. So we do see bonds are a debt product at the end of the day. Normally when we think about debt-based coverage, you usually have FDs and these things in mind. But bonds are also usually a good avenue where they give better returns normally when compared to regular money lying in an SB account, or let's say current accounts where they don't carry anything, or FDs also, which now the return is a bit more decent, but again, they don't offer very great returns. Normally, they don't beat inflation as well. Whereas in bonds, sometimes the returns are good, but that also results in higher risk as well. So that is one thing. And there could be products which are given by the government, could be by PSU banks, or could be by PSUs for that matter, and which are by state governments, and which are also by private companies as well. People tend to favor governments more than private entities, because there is that, at the end of the day, that factor that the government may not let default at government. That is usually what is kept in mind, but we'll need to keep in mind what we are investing in at the end of the day. And there are mutual funds which are launched by government-backed companies as well. But you will have to see where that mutual fund invests in. This is not related to bonds. I was just talking about which. Sometimes people are just misled by the name of the fund house. So some people may feel that just because I invest in something launched by SBI or Canara Robeco, not to say that take anything away from these companies, but you have to see what they're investing in. What is the underlying product, what they're investing in, not just who is launching. Now, coming back to bonds, what happens is, in case of the government, there could be government bonds as well. RBI itself can issue bonds on behalf of the central government. There could be state government which launches. There could be local bodies which issue, and there could be government companies which issue bonds. And in between, there was something called a tax-free bond as well, wherein the interest rate on these bonds are usually exempt. So the rate of return, when you're comparing these with the normal bond, you had to look at it from an after-tax point of view. And what has happened is, but there are cases when people have burned their hands as well, wherein in certain private banks as well, or private companies, some people have invested in bonds, but though the deposits have not normally been affected, wherein RBI usually ask some other bank to take over, but this is the deposits, and make sure that deposit holders are safeguarded. But at the same time, that's not the case with bonds. We have seen cases wherein the entire bond value has been because at the end of the day, when you see it from a liquidation point of view, bonds are at the end of the day debt instruments. So there is no guarantee there unless it is backed by security, but it's still the value of the security may have eroded or multiple things like that. So the bond in certain cases are quite risky as well. And we have seen certain cases wherein people have invested lakhs together have also lost out the entire money as well. So where you don't be misled by the rate of interest, please also check what you are investing in, which company you are investing in, and all. Based on that, take a decision, because when you are there are cases wherein people have burned their fingers here as well. And there are certain bonds where certain players also give loans on these things. So because normally bonds are not a very short-term product, they're usually long-term in nature. We see them for 7 years, 10 years, sometimes 15 years, and so on. So liquidity sometimes becomes an issue. Some of them are listed on the market, so you can exit as well. But again, there should be buyers for that product as well. And based on the interest rates, there could be the prices could be varying. The bonds with a lower interest rate may have lesser demand, a higher interest rate may have more demand, and yield factor and all these things come in such cases. And there are government-backed securities, there are corporate bonds, the inflation indexed bonds as well, which is issued by the RBI nowadays, because we see a lot of them, the returns given by many of the products in absolute terms, if you see them, they may look to be average or decent. But at the end of the day, if you subtract the inflation factor, so many of the products will be below the inflation rate as well. The returns will not even beat the inflation. So what happened? For these reasons, RBI came out with inflation indexed bonds as well. And then there's government securities, which is usually considered risk-free. It's not 100%, but 100% risk-free. There are certain countries where we have seen government securities default as well. But in India, for the central government, as far as that is concerned, normally has not defaulted. The state governments, we have to be a bit more careful. There are corporate bonds, as I was telling, there could be private companies who may issue bonds, because they will also get, it's a win-win situation. The person who invests will get a better rate. The person who is borrowing, at the end of the day, he will also get a better rate than what he would get if he's trying to do it from the markets. Now, what are the risks involved? Like I was saying, if the interest rate falls, then what happens is the bonds usually with the better rate usually rise, but the other way around as well, if the interest rate rises, then that can result in a fall as well in the prices. There is credit risk, because we don't know for sure if you get the money in certain cases, or to what extent we'll get the maturity amount. So be careful when you're investing in this product as well, even though it is not as risky as equity, but at the same time, it is more riskier than products like FDs and all these things. So the risk point of view is low to medium. The returns are quite okay. Again, it varies. They are listed and it can be sold in the market, well and good. Otherwise, you may need to wait, or sometimes you may get loans against this product. And these could be some of the other options wherein you can get some liquidity as well. Now, equities, I believe this is referring to equity shares in general. So they are normally, you are usually getting, depending on whether they are small, could be categorized into small caps, mid caps, and large caps. A smaller cap shares can usually give a better return, but also has a higher risk, because if certain investors stop backing that shares and there's low volume, you're not in a position to sell that shares as well. We see a lot of shares which are illiquid. They may be listed on the market, but still you may not be able to realize any returns on that product. But many of these shares also give a very good return as well. There could be mid-cap shares and there could be large cap and blue chip shares, which normally give a decent return. And normally, if a person is not very sure which they can invest in, a blue chip share is usually a good recommendation where people can invest in. But at the same time, they need to make sure that they monitor on some frequency, because company which may be very good on a certain day after certain years may also not be that great as well in the future. But there are certain companies over time we have seen they have stood the test of time and they have given good returns. So equities normally give good returns. The dividends may be average. So not all companies may want to declare a lot of dividend, because at the end of the day, this is something which we need to keep in mind. As and when they declare more amount as dividend, the internal accruals also goes down to that extent. So it will be reflect in the stock price as well. There could be companies which never declare a dividend and could be very highly priced, or there could be companies which regularly declare a dividend, but you may not get a great growth in those shares. This is due to the same factor. And of course, there could be, we have seen a lot of wealth creation happening in equities. You may have seen cases wherein people may have invested for a few decades and seen phenomenal returns, or people may have seen their parents who have invested, or other relatives who have invested, and over time they have got great returns as well. This is more from theoretical point of view, I believe. And the taxation of it is a bit, I mean, though I don't want to go a lot into it, but short-term gains is usually taxed at 15%, whereas the long-term gains is at, I think today at 10%, I believe. And so this is, the risk factor is high, because like I said, if you see the liquidation preferences, equity is last at the end of the day. There is no guarantee that you get your money back in this product. But for these reasons as well, the returns are also good normally. And you have to be patient as far as this product is concerned. If you put something today, you cannot expect something in the following week. But if you wait it out for a few years, normally in good shares, you will get a good return. That is normally what we see. The liquidity is good in case of listed equity shares, because normally you can get money can be withdrawn at any time. It is just that you have to see factors like volume, which we need to see, because with a higher volume, normally you can always come out anytime. But shares with lower volume or no volume, there sometimes you are not able to get back the money, because the money is, unless someone wants to buy that share, you can't sell off your share. So these are some of the more riskier products and some of the decent products as well. I think we are more familiar with these products as well. So some of the more traditional products, though I think all of us do know about this, I can just take a few minutes on that. So there are products like PPF, wherein it's a government borrowing at the end of the day, where a person can invest in. It's a longer tenure, about 15 years, and you can do withdrawals or loans. The returns, though, are at the end of the day, since the government is giving them, there is some measure of guarantee there, but the rate keeps varying. So on a quarterly basis, I think the government can determine to change the rate. Sometimes they may not change the rate as well, so it can remain constant as well. And interest is usually tax-free over there. So when you're comparing interest rate with other products, you may need to see the post-tax interest rate on taxable products and then compare them here. The risk is very negligible. The return is quite good. The liquidity is average, because you can't withdraw the entire sum, but you can get a loan, or you can withdraw certain sums as well. So both these options are available as far as this is concerned. Now, one of the products which came in a few years back was Sukanya Samriddhi Yojana, or SSY, or so this is only for girl childs. So people who have daughters, they can invest it. There are certain age limits prescribed. You cannot open the account, I believe, after 10 years or so, and you can save the money for their education or for their marriage. That is the purpose which is prescribed in the scheme. the lock-in period is quite high here. You cannot just withdraw the money, but you can invest very small sums. So at the end of the day, they're called small savings scheme because anyone with a very small income also can invest in this, and you can get returns in ATC. And but at the end of the day, with the new scheme getting more and more traction, I think deductions under ATC could be a thing of the past, or we already have so many avenues where you may have already invested and are already getting that benefit, wherein that may not make much of a factor. The maturity period is quite long. It's about 21 years. There are certain factors there which are prescribed. So at the end of the day, there is a low risk as far as this product is concerned. The return is quite good, and the liquidity factor is not, I mean, it's not that high, but it's average. But at the end of the day, if you compare products of PPF and SSY, usually SSY gives a nominally more return than a PPF product. But of course, there is a restriction wherein everyone cannot invest in that product. Only if you have a girl child, you can invest in the SSY scheme. And there are some withdrawal options given, but that is only for a specific purpose. You cannot just withdraw in PPF, though you can withdraw without any purpose as well. But in SSY, it is only if there is that specific purpose which is prescribed, I believe you can withdraw that. And the separate investment limits is that if you compare PPF and SSY, in SSY, there is a separate 1.5 lakhs which you can invest in. But in a PPF, usually for a minor child, the parents' PPF amounts are also clubbed in. So people who may not be very familiar with this factor can keep it in mind that you have to keep in mind both for a minor child in a PPF, it will be the parents and the child which is considered, but for an SSY, it's a totally new limit which is prescribed. And of course, there are certain restrictions because since a special product, they are not, you can only have one girl child can have only one SSY. You cannot have multiple accounts for one child. And one family can have a maximum of 2 SSY accounts for 2 children, with certain exceptions for multiple births and all those things. But I'm just covering some of the basic factors. Now, one of the major things which we normally see for any person is the post-retirement income, which we see that in the past, let's say people who are in government jobs or banks, they used to have a pension. But in today's day, even in government banks, they don't have a full-fledged pension. They also fall under certain products only. And in many private jobs or those are in businesses, they don't have any post-retirement income. Though their regular income may sometimes be better than a, let's say, a PSU or a government job for that matter, but they usually don't have a post-retirement income available to them. That is why this product was launched, I think about more than a decade now, since it is launched, a national pension scheme. And there is a small tax deduction as well available as far as this is concerned. And what happens is a voluntary retirement scheme, which anyone can invest in for that matter. In certain cases, I think government, for newer government jobs, I think they are not giving a full-fledged regular pension like in the past. They will have to invest mandatorily in the NPS itself. But otherwise, for any other person between the age of 18 to 60, which I think is further relaxed in certain cases now, but normally 60 is considered because normally that is considered as a superannuation age. So you can invest in the NPS Tier 1 account, and there are 2 accounts, Tier 1 and Tier 2 accounts. But Tier 2 is a more flexible account where there are not a lot of restrictions, whereas a Tier 1 is has a lock-in wherein you cannot normally withdraw funds up till you reach a certain retirement age. So this is in a way good, because what happens is, like I said earlier, when the money is available, sometimes people tend to spend it rather than save or invest it. So when money is locked in, it usually tends to give better returns because it will remain invested there. So it's a good product at the end of the day, and people can really invest in it. And there is no there is no fixed sum involved. You can invest any amounts for that matter in this product. It's a good product which has been backed by the government. But at the end of the day, there is no guaranteed return here. It is a market-based product, because what happens is it usually there are, I'll take you through the various things which it invests in. So it is voluntary and it is portable, and what we can see, it is well regulated and flexible. So it's a good scheme for as far as those things are concerned. There are certain tax benefits which you get. It is not 100% exempt or deduction to a certain extent. Up to 50,000, I believe, over and excess above your ATC, you can invest in it. Though ATC is becoming more and more irrelevant because of the new scheme. But the investment, what happens is it is done into, normally one is equity, the others is in corporate bonds, other is in government bonds, and certain other products alternate. So the cap, what is, there are certain things which you can do. There are certain criteria which are prescribed. Let's say what happens is normally a person can at the end of the day invest into the NPS, and there are two options wherein there's an automatic scheme and there is an where we can choose manually as well. Now, an automatic scheme based on the age criteria, what it does is on certain blocks, the younger you are, the exposure to equity is more, and as and when you get more older, the equity exposure comes down to a certain extent. Percentage points keeps dropping. And at the same time, this is to keep in mind, because in any retirement planning, one should keep in mind that a certain number of years prior to the actual retirement, you should slowly come out of equities or drop your equity exposure, so that if there are any unexpected situations like a market crash, it should not affect your corpus. That is the idea normally in an investment mind frame, and that is also what is followed in this product as well. So equity, it invests in equity as well. It invests in bonds to a certain extent. There are percentages there. So you get a good return as well. I mean, you get a regular return as well. In equity, you get a good return as well. And the risk is balanced. And there are certain portion invest in government bonds, and certain, I think in certain cases, in certain alternative investment products, but it is a very small percentage. And there are corporate schemes as well, wherein companies can put their employees into this product as well. And there is central government scheme for employees who are part of the government, and for state government as well. And any normal person who is not employed in the government or any corporate can also invest in this product. And it's a quite good product at the end of the day. There is some tax benefit as well, but tax benefits at the end of the day are something which I think we should look at maybe at the last point of time. Normally, the other features should be first looked at, and then maybe you can look at the tax point of view. The risk is not very high. It's quite medium or average, because at the end of the day, they invest in equity. And what happens is, when you want to subscribe to NPS, there are multiple fund managers who are there who you can invest with. There could be SBI, LIC, and ICAI, and Kotak, and so on. So as I said earlier, just because you invest in LICs or SBI's backed scheme doesn't mean you will get guaranteed returns or better returns. They are just fund houses at the end of the day. You can also see the past and decide, or the future and decide as well. And what happens is the returns are quite decent. If you see over the people who have invested in that fund, or even you can see past performances, the returns have been quite decent. And liquidity factor is not that great, high, because at the end of the day, the idea is to develop a post-retirement corpus. So for that reason, you need to keep your money locked in till a certain point in time. There are certain exceptions given, I think, but normally in most cases, it is only at the retirement age where you can withdraw this money, which is really an added advantage, because you really get good returns because of this factor. And over a long-term tenure, normally you get good returns. So it is quite a good product, and if people have not taken it, it's really worthwhile to have a look. And in today's day and age, we see that even people who are practicing, or those who are in business, or those who are in private jobs as well, there is no post-retirement shield which is available. So we have to build it up at our end itself. And this is one of the good products wherein you can invest and do that. It's quite well regulated, systematic, and there are so many things which are there in mind. And one of the popular products and one of the older and traditional products as well is gold. So is it an investment or an hedge? I think that is debatable at the end of the day. Some people may not call gold as an investment by itself, but people who have seen the rates increase over the years could be quite astonished at some of the rates actually. If you see over the last 2 decades, we have seen the rates climb from somewhere around 5 to 6,000 to today could be around 50 to 60,000. So it's about a 10-fold increase. So that's quite a good return. And normally what we see is it is normally in anyone's portfolio, it should be a part of the portfolio. It may not deliver returns on its own, but at the same time, when there are difficult situations, usually it gives a good return. If you see here, I think 2020 was when COVID came in. We see there's about a good return which gold delivered because of the uncertainty involved. And gold is usually a natural hedge against most products. And additionally, you have so we see that over years it has delivered, in certain years maybe negative returns, but normally it has given good returns. And of course, it during crisis, like I said, it gives a good return. One of the major advantages is that it can be pledged. We are seeing so many cases wherein if you have gold, people are ready to lend you money. But otherwise, sometimes what happens is without any security, sometimes difficult to get a loan. Whereas with a product like gold, normally anyone is ready to lend you money without any looking at other factors like income. They are just ready to do it just like that. And then what happens is there not be much of a risk. There's not a lot of inflation, and it is nowadays it is available in digital form as well, not just in physical form. And it during crisis as well, sometimes it is it gives a good return or a good risk is adjusted. And what happens is it is socially as well. People are everyone in the family may be very happy if you're investing in gold. And normally it is socially well recognized product wherein people invest in gold and do gold ornaments and all these things. But in today's day, not only the physical gold, there are so many new products which are there in gold as well. So the physical gold is something which all of us will be well aware of, because we have been seeing it being done from generations together. People have a belief that gold will not fail at the end of the day. But there are new products which have come in. There are gold ETFs, which mirrors the gold price. And what happens is, unlike physical gold, where there is, if you want to do it from a purely an investment point of view, in gold ETFs, normally there is no making charges involved, there's no GST involved, there is purity is not of any concern. Whereas in physical gold, you have these concerns in mind. Also the storage and all these things are something which you can keep, which you don't have to worry as far as gold ETFs. But in physical gold, it is always a worry at the end of the day. Is it safe? Can I keep it at my place? Whether I should keep it somewhere safe? These are things which comes in mind. So as digital gold is concerned, there are so many products we are seeing in fintech companies offering them. We are seeing companies like Paytm, PhonePe, and all these people. But at the end of the day, they are just intermediaries. The companies which are actually giving them, there are, I think, just 2 companies, a handful of companies which are doing them. One of them is MMTC, and the other company is one, I don't recollect the name of the other company. But in case of digital gold, there is a GST gets added to the price, but at the same time, there is no rate. There is again no wastage charges involved, and there is no concern about purity. Sovereign gold bond though is a very innovative product which the government brought in, because normally what is happening is gold is being imported, which is one of our major imports other than petroleum, other than crude oil. So this impacts our foreign currency movement. So that is why sovereign gold bond was brought in by the government, where at the end of the day, it is given by the issued by the RBI on behalf of the central government. And one additional feature here is that the government themselves gives you an interest rate when compared to most of the other gold products. This is a very added advantage, though the interest rate is quite low, it is 2.5%. But rather than other products, you do get something other than nothing. And at the same time, the market price of the gold will also be available to you. And if you hold on to the product till the redemption, you get a tax exemption on the capital gain as well, which in all other cases, you would need to pay any capital gain if there is any gain involved. But in SGB, if you are just holding it till the maturity, that is not there. And then there is gold mutual funds as well. There are mutual funds which invest in gold, which are similar to the other products as well. But there are it is being handled by a fund house, and all these other things which happens in a mutual fund is being done in this product as well. So the risk factor is low. The returns are medium because gold by itself doesn't deliver any returns. It is only the price of increase which gives and the liquidity is quite good, because at the end of the day, it can normally be sold. Physical gold may have some issues like wastage and purity and all these things, but still it is widely accepted, or it can be pledged as well from very formal channels like banks, NBFCs, to even small time. We see even in the smallest of places, you will see pawnbrokers and money lenders who accept these things. So the liquidity is quite high as far as gold is concerned. And the returns, I mean, I don't need to tell much. I think people who have invested have seen that over the years, or people who have had gold and who are trying to purchase more gold get to see this. But the returns over the years have been quite good as far as gold is concerned. Now, one product which I wanted to tell, though it is not purely an investment product, but at the end of the day, something which we are which is a very simple product which you can purchase at a low price and get a high risk coverage, is term insurance, which we see so many people, or maybe other professionals whom we see in our day-to-day life. We see that many of them have passed away at young ages, and they have a lot of family commitments and all these things. So one of the main things which I advise everyone, or I suggest everyone should have a look at, is take a term insurance product. And the earlier you take it, you usually get it at a lower premium. The later you take it, you will get it at a higher premium. And let's say you have any medical conditions like diabetes or blood pressure, high BP and all these things, usually your premium goes up, or sometimes you may even refuse this. So let's say in a traditional product, let's say I pay a 1 lakh premium, my cover may be around would be around 10 lakhs or 10 times of it. Depends on the age group, but I'm just talking in general. But in this product, what happens is just in a few thousands or so, you can get covered even up to 1 crore or so. So it is there are various products wherein the ICAI is also tied up with some insurance companies which can be taken. And there are other products as well which are offered in the general market as well, wherein you can take it. The premiums are very affordable. And there are certain other riders which you can take, critical illness and accidental death benefit and all these things, wherein even wherein sometimes if there is no death as well, but if there is something very critical which impairs you for life, you can still get the benefit. It is you can get tax benefits, of course, under ATC, and critical illness under ATD as well. But it is a much required product, and especially not only people who are having any incomes. Many people feel that I don't have any dependents, why should I do it? But even persons who are, let's say, bachelors or are not yet married, at the end of the day, there is someone in your family, sometimes your parents or someone who today may not be relying on you, but at the end of the day, in the future, if this is there, that gives some level of comfort. Of course, Nothing can replace a person. But end of the day, this can give a good, some adequate cover. The risk is not that much, but at the end of the day, you should keep in mind it's not a traditional insurance product. So if you stop paying the insurance premium, then the policy lapses. The returns, there is no returns as such, frankly, in this product. There are certain products with you with return option, but that is a bit different, wherein you can get something with, but your premium gets increased to that extent. And the liquidity is also not very high actually. So that's why it's showing under high, because there is, you can't pledge these normally, because unless someone passes away, there is no value to those policies. But there are multiple options wherein you can take a limited term policy. So you can, in 10 years, take a cover for 30, 40 years, 50 years, or 15 years. So you need not pay until that age, until that level, but you can get a coverage up till a large level, but you can pay only for a few years. So person who may be already in a position in life where he is getting his decent income, and he may not continue to keep getting that income, can look at such options. A person in a younger age group can look at a normal plan as well. So these are some of the options available. And also, wherever you are borrowing uh, for whatever purposes for that matter, for house or business or whatever, is highly advisable you take some insurance along with that. There are many products nowadays wherein many of the private banks take a specific insurance cover along with this. In some of the PSU banks, we are not seeing this, and sometimes we see that, because, or in some private banks as well, this may not be there. But in case of death of the major partner or major director or the proprietor or the individual for that matter, the rest of the family members may struggle to repay the loan, or rest of the partners or directors. It's highly advisable to get yourself covered for this, for the benefit of your family. Of course, there may be points of view like there is a property concern, but wouldn't it be better if that property still remains? Because if the other person will not be able to repay that loan, they may need to sell off that property. Rather, if that cover is there, they may be able to close that loan at the end of the day, and the property can still remain with them. So it is a really advisable product. And of course, there could be medical checkups which you need to do, but the insurance company will pay for it. And many of the times you have seen some people get to know about some medical conditions only when they do this. So there are people who thank the insurance companies as well, that I got to know because of you that they had this issue. So that could be one more thing, but it is highly advisable that you should take this product. And one of the other products I wanted to explain, which everyone knows at the end of the day, is a fixed deposit, which is a very low risk investment. It is provided by banks, companies, but it is also provided by societies and corporates and all these things. They usually give a guaranteed return, but it can have a lock-in. There is the DICGC coverage is only up to 5 lakhs. This is even for PSU banks, but normally the government has not let a PSU bank usually fail. On many of the cases, even a private bank, they have made sure that it is taken over by some other bank. But we are seeing so many cases wherein there are societies and cooperative banks which are defaulting. So please keep in mind that the coverage is only up to 5 lakhs. And there are many cooperative banks, societies which give a very high return. But please keep in mind, just have a look how safe your principal is in such cases. And there are also certain companies which give the companies which can also offer FDs. But at the end of the day, these FDs are not protected under DICGC. Even housing finance companies which offer FDs are not covered under this. So please be very sure when if you are keeping an FD, or if you know someone who is doing it, to keep this in mind so that they do not face any unnecessary issues tomorrow because of some management issues in that bank or that society for that matter. And there are multiple, of course, senior citizens usually get a better ones. RDs, then the tax savers. Flexi FDs is a good product wherein your SB or current account beyond a certain point gets automatically converted to an FD. And whenever you give a payment, that gets withdrawn automatically as well. It's quite a good product. Of course, there are various things which have come nowadays, where there are floating rate FDs also which are available. The risk is quite low. The returns are medium. Liquidity is quite good because you can usually, in most cases, withdraw it. Maybe in certain exceptions, you may not be able to withdraw, but in most cases, it is more liquid in nature. So this is what I wanted to explain. So if there are any questions, please let me know. I am happy to answer them. Admin, is there anyone there? Are there any queries which have come?
Thank you so much, sir. There is no question was there.
Is there anyone who would want, if I mean, you can leave it open to the audience in case they want to ask any queries.
No, sir, there is no,
Okay.
nobody there raised their hands, sir.
Okay.
Shall I end the session, sir?
Okay, sure. That's fine.
Okay, thank you so much for your presence and time, sir, and thank you so much for coming, sir.
Okay. Thank you.